Hello, and welcome to the Lend Hoping That a Thing podcast. I'm Michael Humpherys. I'm happy to be talking to you today. This is episode 34, and today I want to be talking to you about various forms of investment and some of the principal arguments that I've been thinking about with respect to different investment strategies. The main distinction is going to be between short-term and long-term investing. And the first thing I want to do is develop some distinctions. So the first distinction I want to make is insider trading. So insider trading is when you buy or sell some security having knowledge not readily available to the market. And so and it has to be materially significant to its price. So for example, if you know that a company has 135 parking spots at their office. Maybe that's not readily available to the public. It's not insider trading if you know that, because it doesn't materially impact the price. But if you know that the CEO is going to change, or if you know the financials that are going to be um, put out to the public during an earnings call the next day, that would be insider trading if you use that information to then go on and buy and sell those type of securities. This type of stuff is well known in it's become a big topic, especially in the government, where congressmen and women know certain things about what the government is doing or have more information than the rest of the country, and so use that information then buy and sell stocks, which then becomes problematic. And the reason I say that's intrinsically evil is because it's you have knowledge about what the just price should be when the rest of the market doesn't. So the market not knowing what it is kind of not as important. What's relevant there is that you can sell it at a price different from the just price. And so you have information that gives you better insight into what the just price is. And so then you can sell at a systematically higher or buy at a systematically lower price than it's being commonly sold in the market. And so that's intrinsically unjust. And Thomas Aquinas talks about this in Secunda Secundae, question 77, article 1, response to the second objection, where he talks about the desire to sell high and buy, or to, sell high and buy low are arise from vice and not from nature, because they're contrary to justice. And he gives the example of Augustine, who talks about someone who pays the just price to someone who is ignorant trying to sell at a lower price. And so this is still evil because you know what the just price is, or at least you have better insight into what it is. And so you're trying to sell it at in fact, you're trying to make a profit because of the market effectively's ignorance. And so insider trading is just unjust. I've heard people talk about like it's wrong because it does harm to people, but no, it's unjust in itself, because it's not merely like taking advantage of people, but it's giving a price for something for more or less than its just price, and so it's contrary to commutative justice. So insider trading, lay that aside. Now, the next thing I want to talk about is the distinction between short-term and long-term trading. And for this, I'll kind of set up, short-term trading as being something like less than 3 months. That seems like a long time, but the reason I kind of put it at that length is because most modern corporations are on a quarterly cycle during earnings calls and releasing financials every 3 months. And that's kind of the idea, is that this epistemic um, change where we actually have an idea of the way things are changing. Now you can kind of shorten that down, and because of maybe in between quarters over that time there's more going on. So like someone starts a war in Eastern Europe or the Middle East, or blockades a vital um, trading uh, lane, just to give some recent examples. And then it has impacts on the market. So, but the idea here is that the time frame is short enough, and that's going to be essential to the argument. And then you have longer term investments, which is going to be, you know, beyond that sort of short period. But I would say longer term investments are going to be, years is probably the most likely option. So the sort of principled argument against, let's take very short term, so like intraday trading. And so this is going to include like high speed trading, where you're buying and selling fractions of stocks or whatever in mere seconds, or fractions of a seconds or microseconds or whatever it is. And so the principled argument here is that the 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 company has a value, and part of that value is going to be its book value, so the actual assets that it owns, and the sort of ability, the price it could liquidate those at. So a liquidation value. So if it stopped all of its operations today, there would be a price at which it could sell all of its present assets. And so that's kind of maybe like your baseline for the value of the company. Now, in addition to that, there is all of the future revenue that's built in based on its ongoing operations. And so there's a bunch of different models on how to calculate that, and it has all sorts of different assumptions. So you have something like the discounted free cash flow model, where essentially, basically how much profit are you generating over the next 5 years? How much is it going to grow? And then you discount it back to the present. And so then you have the price of the stock today, which includes some estimation of the value of the current assets, along with the future cash flows that it's going to generate over time. And with this, you can come up with a value. And so the value has the future kind of already baked in, which is going to be an important point. But the issue with very short-term trading is that the price of the stock, security, whatever, is there is no reason to believe that the actual value of the company has changed second to second. Like there's no possible information that come out that would shift the value of the business by that much. Now you can have real shifts, like when there is an earnings call at a company and they reveal like, oh, hey, we missed our targets or we greatly exceeded our targets. Typically you'll see like big shifts, and that's the market recognizing essentially that the just price has actually shifted. Not to say that the market price is the just price. That's not what I'm saying. But the market's realization of this new information flows through the market to update it to be closer to what the just price is. And so in a very short span, there's no reason to believe that um, the um, the just price has actually changed at all. And so there's two possibilities of what I could imagine people are doing. So one, which is the more likely case, is they don't care what the just price is, in which case their acts of buying and trading are just irrational and unjust, are um, at the very least irrational and most likely unjust if they just don't even care. They're apathetic. Um, yeah, because they don't have a constant will to render the due to another. Um, or if you do care about the just price, um, when you by the act of buying or selling at a price, you are acting as if that is the just price. And so, in fact, you could say this truly of the person who, sort of with a cognitive dissonance, doesn't care. Um, but what you were saying when you buy or sell is you're saying, this is what I, this is what the just price is. And so when you then, within seconds later, shift that to some other price, um, without any reason, because the time length is so short that you have no rationale for why that should be the just price now, then essentially you're saying one of those two, the buying or the selling, was unjust. And so that's why I think very short term selling is generally unjust. So, um, that very short term where you're buying and selling within a period where there's no relevant information as to why the just price has changed, those acts of buying and selling are unjust. Now, a lot of the times there's a lot of situations even where the market just goes crazy because of some new information, because people get scared and greedy, when in fact that information really doesn't have an impact on the markets and the value of the business. And so, like, in those types of cases, um, you can often say that that's, people probably aren't acting unjustly, but they're acting imprudently. And so buying and selling at those prices is probably imprudent. But a rational person, a prudent person, taking advantage of that irrationality and imprudence would still also be unjust, because the justice of your act is not determined by the condition of the foolishness of others. It's according to the justice of the act itself, the thing, the equality of thing and thing, um, especially in commutations. So taking advantage of people's stupidity and greed or fear um, is also unjust. So there's that. And so that's generally why I think very short term period uh, buying and selling trading is unjust. Now the longer term is kind of a bigger question for me, because one of the things, as I mentioned before, was that, well, the future is already kind of baked into the price. So when everyone in the market is kind of thinking about it and thinking about how valuable the stock is, not really everyone, but the most sophisticated traders, they're not only thinking about, well, what's good about it today, but what's going to be good about it in the next, you know, uh, 1 to 5 years. That's the kind of timeline that I've seen of the discounted cash flow models. Um, and so then the question becomes like, well, what does it mean to actually buy and sell in a buy and hold strategy where you're holding it for long periods of time? Because if you buy it and you think it's going to go up, then doesn't that suggest that you're buying it uh, at a lower price than it should be because you anticipate it going up in the future? The issue here, though, is that um, with your discounted cash flow model, um, so for example, if you think that the company is going to grow faster than is implied by the current price, or it's going to generate more cash flows, or less on the downside as well. Doesn't that suggest a mispricing? And so there's two aspects there. There's you agree that the price it's being sold at is the just price, and you buy it at that amount. That's the price you pay. Now, can you sell it for more later if the price goes up? And that's certainly possible because then in the future, what's actually happened is that the discounted cash flows have been realized and are no longer discounted. They're now actual, uh, fully undiscounted cash flows. And so then, yeah, the value goes up because now it has those undiscounted cash flows, and maybe it reinvests it in the company, which then grows the company. And then once you look at the next 5 years, you have a greater cash flows in there. So there's good reason why a buy and hold strategy could be good for the long term. And so you can still buy it at a just price today and then sell it at a higher just price tomorrow, because even though the future is priced in, the future is not actualized yet. And so maybe in 5 years, after all those cash flows are now actual and not discounted anymore, the company is actually worth more because it's accumulated all that additional value um, into the company actually now. So that's one side of the question. The other side is when you actually think the company is going to grow more or less or whatever. And this is one of the things that I'm opposed to value investing, is because value investing is intentionally looking for companies that are undervalued. And on one podcast I listened to, a value investor said he would use his models to determine which companies were at like 60% of their value according to their model. So they have like 4 or 5 different models, and then they have some sort of convergence test that they do between these models to a particular price. And if they find that that company is like 60% of that value, then they'll buy that company. But all that tells me is that you are looking to do exactly what Thomas Aquinas told you not to do, which was you're trying to buy as low as possible, even though you know it's worth more. And so then that is like value investing, at least that strategy of value investing is radically unjust, because you are looking to buy as cheaply as possible in order to then sell it at maybe the just price. You got to wait for the market to actually obtain to a higher amount. So the market has underestimated the value, and so you're taking advantage of that underestimation to get a steal. And so, yeah, it's unjust. And the way that financial people will justify it is to say, well, these people who are taking advantage of these situations actually help the price move to the just price. And it's like, yes, that's sort of a pragmatic reason, like that they, it's helpful that they do this, but it's also unjust. Sure, the activity itself will kind of move the market in the right direction to correct this mispricing of a security, but your 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 correction of it is through unjust acts of buying and selling. So um, I had about a year ago, I was looking at value investing and creating my own discounted cash flow model. And then I started thinking about this and I was like, yeah, I mean, like the strategy is you're looking for something that is under underpriced, mispriced by the market in order to take advantage of that and to make a profit potentially. And that's exactly the situation that Aquinas is talking about. Is there's this guy selling a book for less than it's worth, and you should sell it. You should buy it for what it's worth, not what he's selling it for. And so the market price is not the just price. In fact, that's exactly what those models are telling you is, hey, based on fundamentals and a arbitrage theory and whatever other models they're using, what the just price is 40% higher than what it's currently being bought and sold on the market. So you should tell the seller that is effectively what Aquinas would say. Now, you're going to have all sorts of unjust and dishonest people, taking advantage of you because of that. But ultimately, to me, that says you should just not be involved in value investing or buying companies that are at 60% of their fundamentals. So that's kind of the big thing. So for me, I think a buy and hold strategy where you're looking towards the actual growth of the company over time, that seems like a reasonable and just strategy. Now there's all sorts of things that might go on with that. Maybe your opinion is that it's going to grow faster or it's going to grow slower. So there's some variance of uncertainty there. And so, maybe you should pay more than the market price for it. At that point, I think there's a little bit more leeway because it does involve such uncertainty and estimations and such. But the only reason I could see that you would kind of hold that with certainty that it was going to grow faster than the market expects is if you had insider knowledge, which would be unjust. And so there's quite a bit of uncertainty there from which you could probably, more or less, like maybe you think it's going to grow, like the market has it priced in that it's going to grow at like 10%, and you think it's going to grow at 12% or 15% or maybe 6%, something like that. And you price it in and you say, well, it should be worth like, the price should be 5% higher, depending on all sorts of different assumptions. So there's a certain level of humility there where you have to recognize the actual assumptions that you're applying and that you might be wrong. And so from the point of view of justice, I think, a lot of it is estimation. And I think you can, in good faith, say, even though you kind of think a higher growth should be priced in, that you're uncertain about that. And so you're going to take the risk that maybe you're wrong or that the market is right, and you'll pay at the market rate. But if you think you're right, you probably should pay a higher than what the market's going for, because you maybe have really good reasons to believe that it's going to grow faster than the market has it priced in for. But a lot of what we talk about with investing is, well, we're just going to buy and sell at whatever the market is at. And there's good and bad parts to that, because sometimes the market, those prices are incredibly irrational. Like, there's no good reason that some companies are as highly valued as they are. And this is well documented. Like, just being added to the S&P 500 makes the value of your stock go up. Like, nothing about your company is changed in its value and what it does by that, but just being added to the S&P 500. Now, maybe you can get some better credit ratings, or but realistically, the big thing is that more people are going to be buying and selling that stock, and it's going to be part of every S&P 500 mutual fund. So there's a lot more going on. There's maybe some incidental value increase from being added to the S&P 500 index, but I'm willing to bet that the majority of the value of the price increase is not due to those incidentals. So yeah, those are kind of my thoughts. So you have insider trading, which is always unjust, because you're buying and selling based on the ignorance of the market, so that you can make a profit. There's very short-term selling, which is necessarily irrational, because there's no good reason to believe that the price has changed. And the very act of buying and selling at a particular price implies you believe that is the just price, and then you buy and sell at a different price. And so by those very acts, you are admitting your own guilt, is the way I kind of think of it, that you are acting unjustly. The best kind of, and I should say, none of this is financial advice. This is all moral analysis of this. So please do not listen to me. I don't want to lose my FSA because people are taking financial advice from me. So consult a financial advisor who has proper fiduciary training and so forth. So, but I think morally speaking, the buy and hold strategy is probably the most just, because I think you can do it in good faith, and growth is based on, even though it's already priced in, it's still based on real fundamentals. It's based on things that really do matter. And value investing, I think, is just a crime. It's just a fraud taking advantage of ignorance and mispricing, which in a virtuous world would not fly. So those are my thoughts. Again, I'm not a financial advisor. Don't take this as financial advice. This is my thoughts for the good of souls, I guess. Yeah. Ultimately, I'm just some guy on the internet talking to a speaker. But those are my kind of considered thoughts about buying and selling and the morality of different investment strategies. So if you have any thoughts or objections, I'd love to hear them. Feel free to leave a comment or send me a message. I'm always happy to talk to people. And yeah, Have a good day.